Well, hi everyone, and welcome to the Buffett and Beyond Research Stock of the Week. But we're going to do something a little bit different this week. We're going to look at how we form our growth portfolio, but with a defensive posture. And we've never shown this before because we just do it all the time. But now we're putting it out to you so you can get a good feel of how we select our stocks. So remember, if you want to walk on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. Now, here's some of the things that we have to look at. The key to sleeping at night while you are fully invested in a growth portfolio is to use a host of defensive but growth stocks. Now, there are two different things here. We're talking about defensive stocks, we're talking about growth stocks, but there are stocks out there that exhibit both type parameters. Now, then we look at a 30-stock portfolio, which we will hold all year long. We don't want to trade these stocks. Now, sometimes we'll sell covered calls and take on some put positions, and everybody uses their portfolio a little bit different, but the main thing is to have these 30 stocks, and we want to be invested all the time because it's very, very difficult to know when the market's turning around. Now, we look at stocks that did well during 2022, which was the last down year we had, but yet they outperformed the S&P over time. So in other words, we're looking at a defensive stocks that did well during the market when it went down. The S&P was down 19.6%, the Nasdaq was down 34%. So we look at stocks that did well during that time period where the market was just nasty. It was terrible. And now remember, when you look at the various stocks that we pick, our 30 stocks that we buy and hold for each year, and only once a year will we maybe change some stocks that need to be changed and then rebalance the portfolio. And over the past 22 years, so we have a 22-year track record, this type of investing has returned 2.5 times that of the S&P 500 index over this 22-year period. Now, Morningstar came out with a report, about 20 years ago, and they said over any 10-year rolling period, 96% of professional money managers managing the publicly traded mutual funds cannot outperform the S&P 500 index. So what are we doing? We are looking at portfolios that not only outperform the S&P 500 index, but they have a defensive measure to it. So when the market is going down 20 or 30%, which it seldom does, but it does, we don't want to be worried about our portfolio and do something silly like selling at the bottom, which so many people do. That's why the stock market bottoms out, because when everybody is finished selling, then it will go back up again because the economy is growing in this country. All right, let's look at two stocks that we looked at last week, and we look over about 1,800 stocks a year. And we look at, in this case, this is BlackRock, and we use something called clean surplus return on equity. And I can't explain that here because I wrote a whole book on it, and it was also my doctoral dissertation. So there's a lot to it, but it's really a simple concept. You can read the whole book and say, wow, that was simple. But this return on equity is totally different than the traditional accounting return on equity by about 100%. Totally different. So the average stock in the S&P 500 and our 1,800 stock database has about a 13.5% return, clean surplus return on equity. And we found that the entire doctoral dissertation and the book is about that if you pick stocks with higher clean surplus ROEs than the average stock, which right now is 13.5%, you should outperform the S&P 500. If you pick the stocks that have less than a 13.5% ROE, you won't outperform the S&P 500. And so think of the bank account. Do you want to put your money in a bank account, let's say the S&P 500, and get a 13.5% return per year, or would you rather put your money into the clean surplus return on equity stocks that show a higher than 13% ROE. Now, we looked at BlackRock in here, and then we looked at Arthur Gallagher in here, and we compared those two stocks last week, so no need to do it again. But look at Arthur Gallagher has a higher ROE than BlackRock does. So Arthur Gallagher is in our portfolio, our growth portfolio, where BlackRock is not. Now, over the past 5 years, Arthur Gallagher is up more than twice, to about 2.5 times the S&P 500. Yeah, so you've probably never heard of this stock, but it's been around for a very, very long time, folks. So what we do is we look at some of the stocks that were more defensive during this decline of 2022. Again, the bad year for the market. S&P down 19.5%, NASDAQ down 34%. So which stocks out of our portfolios, out of our groups of stocks that have above a 20% clean surplus ROE, how many of them outperformed the S&P 500 during the nasty year of 2022? And this is the black line. S&P is the black line. And which stocks outperformed it? Which stocks did not fall below it? And so then we chart out a whole list of stocks. And over here we have stocks like Costco, Arthur Gallagher, I just mentioned, Chipotle, Apple, and other stocks like Costco and BJ. So we look at those stocks, we say, okay, but have they outperformed over 5 years? So then we go to a 5-year chart, which I'm not showing you here, and then we see how these stocks have outperformed over 5 years. And they all have by a good margin. That's how we can get a 2.5 times return of the S&P 500 over 22-year compounded rate of return. So then we took our 2025 growth portfolio of 30 stocks. This is always 30 stocks. And how did they perform in 2024? Now, I couldn't fit all 30 on here, so we have 2 slides. This is the first one. And we see how did they do in 2024. Now, we had most of these stocks in our portfolio in 2024, so there's only a few different stocks. But this is primarily our 2024 portfolio, and it is exactly our 2025 portfolio. So you can see how did they perform last year, and we see that the majority of the stocks outperformed the S&P 500. Again, the S&P 500 is this black line. So you can see that everything, just about everything, outperformed the S&P 500. And right here, the average is about double the S&P 500. And we actually returned anywhere between 33 to 38% in real portfolios. The model portfolio returned 35%. So almost double the S&P 500. Now, these are the rest of the stocks, which are the other 20 or the other 9 stocks out of the 30 stocks. Let's go back again. These are 21 stocks. They couldn't all fit. I couldn't all fit all 30 stocks on here. So here's the other 9 stocks. Again, black line is down here, S&P 500. And how did these stocks perform in 2024? Well, most of them outperformed the S&P 500. Again, we almost doubled the S&P 500 last year in a portfolio. Let's go back again. In a portfolio that contains stocks that did very well in the bad year of 2022. Again, black line is down here, is the S&P 500. This is 2022. The S&P was down 19.6%. You can see that right in here. And these stocks did very well during that period. In fact, some of them, 1, 2, 3, 4, 5 of these stocks here outperformed the S&P 500 by a long shot. So what does that mean? That means that when we look at our 2024 portfolio, again, there's a few stocks in here that were not in our 2024 portfolio. We changed them out. And now we're looking at a portfolio that did very, very well last year. And now we have those same stocks with the exception of about 5 or 6 stocks that we changed out. In fact, they're in the retail business. We changed them out because retail's just not doing too well, is it? So anyway, we have this is how the portfolio did last year. Again, almost doubled the S&P 500. So that's how we go through the portfolios and the stocks all year long. So you think a portfolio manager picks a bunch of stocks and then rides them and doesn't do anything. We analyze about 5 stocks a day all year long. So we get about 1,800 stocks, and we check a lot of them over after a 6-month period to make sure they're still performing. So yeah, we go through a lot of work. We're working at it every day because you never know which stock is going to outperform unless you look at those numbers. And let's go back to those numbers that we went over last week. And we're looking at stocks like in this case, Arthur Gallagher, and it's in the financial services industry, and it has a nice high ROE and consistent, except for 2023. But if we go back further, which we do, we go back to, in some cases, to 1985 when we started getting the research on this methodology. And yes, this has a nice high clean surplus ROE. It's consistent, and it's one of those good defensive stocks that did very, very well during 2022. So that's how we get portfolios like this, that most of the stocks during any one year will outperform the S&P 500, and the average is 2.5 times or more than double that of the S&P 500 over our 22-year compounded rate of return. So folks, that's how we do it. Easy, isn't it? Once you know how, but it takes time to do it. It takes all year to do it. So folks, that's how you set up a portfolio. And yeah, it's a lot easier to have us do it. And we do sell our research to professional money managers and some of you and those of you who want to do this yourself. And that's how we select a portfolio. So folks, we had a pretty good week this week. We had a great year last, an even greater year the year before. And we're starting off this year doing very, very well. So remember, if you want to walk on this beach like Jimmy Buffett once did, then you've got to learn how to invest better than Warren Buffett does now. So folks, go out, clear your head, have fun this weekend, be with your family, be with your loved ones. Most of all, stay safe, and we'll see you right back here in a couple of days.